Hi everyone, Stephen Dooley, Head of Market Insights here at Convera, presenting our Are You Ready for 2025 webinar. Of course, we produce the Are You Ready series each year to help our customers and our stakeholders identify what might be the big drivers as we enter the new year and to help businesses plan for the FX risks and FX opportunities that might become apparent in markets as we go through 2025. We'll cover today the key global themes of the financial markets and the economic drivers as we go into 2025. Then we'll look at the FX outlook for the major markets that we cover here in APAC. And then we'll finish off with a short conclusion. But first, with the introduction. And our view as we go into 2025 is to hope for the best, but prepare for the worst. The first half of the 2020s has really been defined by big themes each year: the COVID pandemic, then the recovery from COVID, an inflation bubble in 2022, higher interest rates in 2023, and then, of course, in 2024, a year dominated by major global elections. But global growth was better in 2024 than perhaps most forecasters expected. The view was that as interest rates rose quickly to try and contain inflation, that would probably mean that unemployment would rise, and that would also probably mean that we would potentially face a recession. Now, while we have seen recessions in some major countries, Germany, New Zealand, overall global growth has been remarkably resilient in 2024, around 3%. We expect the same around growth of about 3% in 2025. We've seen markets stronger, equity markets at all-time highs, and the VIX, the so-called fear index, fell to the lowest level since July 2018 this year. What's interesting is that while economic data has improved, consumer and business sentiment hasn't. And that's partly because of the overhang of the difficult conditions that we saw in 2022, 2023. If you look at the misery index, which is a measure that looks to add the unemployment rate and the inflation rate, you can see that over 2022, 2023, it was about as high as we have seen in the last 20 years. That said, it's come down a lot. The global economy is looking better, but it's taken a while for businesses and consumers to recognize that. There's been a hangover of this difficult period in terms of the economic conditions. Some people have called this the vibe session. The data's good, but the vibes are off. But we are starting to see a pickup in confidence numbers around the world. Of course, in any introduction, one of the major focuses has to be the results of the election that we saw in the US at the start of November. The big win for Trump saw the US dollar strongly higher, and that's been a pattern that we've seen over the last couple of months. Through August and September, as the probability of a Trump win eased, the US dollar fell. In October, as the probability of a Trump win increased, the US dollar came back strongly. And we saw that after the win for Donald Trump in early November, the US dollar hit a 4-month high. Historically, in the short term, economic markets have seen Republican wins as positive for the US dollar. But over the longer term, that dynamic's actually been different. Over the longer term, Republican presidencies have historically seen the US dollar weaken. So as we think about the election, the 3 post-election risks that we see is that, first of all, that asset prices are very elevated. Equity markets at all-time highs, the US dollar also strongly higher. That produces the risk of a reversal. Historically, as you can see in the chart here, the US dollar tends to change direction significantly upon new administrations. They introduce new policies. And then lastly, the first reaction doesn't often stick. The US dollar reacts differently in the short term and the longer term. And that's what we are saying. Historically, we've seen, certainly in 2016, the US dollar was very strong in the first couple of months after Trump's win. The US dollar fell, though, for the remainder of his presidency. But let's now look at the major global themes that we're looking at in 2025. As we say, we expect the modest expansion to continue. Growth was around about 3% in 2023, around 3% in 2024, and we expect this expansion to continue. Two big factors. First of all, unemployment remains historically low after spiking during the COVID pandemic. Looking here, you can see that unemployment globally is near the lowest level in 40 years. Unemployment is key to driving economic growth. So that's one reason to be positive. Secondly, we expect central banks to continue to cut interest rates. So if central banks cut interest rates, if unemployment stays low, that should provide support to the global economy. In terms of FX markets and the reasons why central banks can cut rates, it's because we expect inflation to continue to fall on the proviso that we don't see shocks in trade. And of course, a shock in trade is more likely with the win for Donald Trump, who has said he plans to use tariffs and trade policy as a means to get political outcomes. So 2 years after inflation peaked at the developed world around 7.5%, inflation's now paused, come down significantly, and that's why central banks are able to cut interest rates. Of course, this will drive some of the volatility in FX markets in 2025 because inflation is coming down at different paces in different parts of the world. In New Zealand, in Canada, it's coming down quicker. So the Reserve Bank of New Zealand, the Bank of Canada are able to cut rates quicker. In Australia, for example, inflation's coming down more slowly, and the Reserve Bank of Australia hasn't been able to cut interest rates, and in fact, doesn't expect to cut interest rates until the middle of 2025. So this should provide the potential for volatility in FX markets because as central banks cut, often currencies fall. As central banks hold, those currencies can hold their position. And for example, like in Japan, one of the few developed central banks expected to hike rates, that could provide support to the Japanese yen. You can see here in this chart how we are starting to see that divergence play out in FX markets. You can see now clearly that central banks have started cutting rates on balance. Through 2021, 2022, and 2023, there was more global central bank interest rate hikes than cuts. This year, you can see in 2024, we've seen more central banks cutting than hiking. Again, that's what will provide support to the global economy. Interest rate cuts are good for businesses, good for consumers, and good for confidence. But the different pace of central bank cuts means that that will drive more volatility in FX markets. One factor that's also providing support to the global economy is that government spending, which increased so much in 2020 and 2021 to provide support for the global economy. Politicians say they want to wind back on spending, but they find it difficult to cut programs, particularly when they are facing elections. So at the moment, we're seeing less and less reduction in government spending. That's providing support to the global economy. And while we do hear more and more talk about governments wanting to wind back their spending, for now, we haven't seen it. And this supportive fiscal stance, while expected to diminish in 2025, will still provide some support. The cuts that we have seen haven't been anywhere near as significant to start really having a negative impact on global growth. Of course, now with the win for Donald Trump, one major focus will be on trade. And this chart is incredible here. If you look back in 2012, 2013, the amount of trade interventions, tariffs, was around 200 per year. Now it's up at 2,000 per year. So a increase of more than tenfold since the mid-2010s. Now, it's not just the US and China where we saw those trade war start in 2018 and 2019. Over the last 12 months, we've seen new tariffs on Chinese EVs into Europe, into Canada. Tariffs are now much more commonly being used as a policy tool than they were 10 years ago. This is only going to continue in 2025. And this means that trade exposed currencies, the Canadian dollar, the Australian dollar, the New Zealand dollar, the Singapore dollar, and the Chinese yuan in particular, could face selling pressure because of concerns around global trade. So when we're talking about the impact on FX markets of these concerns around trade and the impact of interest rates, the impact of different rates of inflation, let's have a look at how this is likely to play out in key FX markets. And starting here with the Aussie US, currently you can see the expectation is unlikely to see a sustained move above 70. The Aussie US has been trading in a range between 64 and 69 for most of 2024. In fact, it only traded higher than 68.40 for a brief period after an announcement of Chinese stimulus at the end of September, and that was very short-lived. So overall, for this year, 2024, Aussie dollar in a very tight range between 64 and 68. For now, we see the risk is that the Aussie dollar likely to be capped in that range. To the top side, the opportunity is that with the Reserve Bank of Australia less likely to cut interest rates, that can provide support to the Aussie dollar. However, any moves above 68, 70 seem likely to be short-lived. And in fact, the bigger risk is for a move lower, down into that lower end of the range you can see on the screen there, 63, 62, 61, if we do see more negative news around trade, particularly US-China trade wars. It's a similar story for the Kiwi, which has been pressured most recently as the Reserve Bank of New Zealand led the charge cutting interest rates. And we saw in particular that 50 basis point cut in October to 4.75, and the New Zealand Central Bank signalling further rate cuts. So that's what's going to be likely to keep a cap on the Kiwi looking forward. And again, any moves above 60, 60, 61 look to be an opportunity for US dollar buyers. This market might remain pressured because with inflation cooling and growth quite negative, the Reserve Bank of New Zealand is expected to cut rates further. The dollar yen has been a real wild child in FX markets this year. It was the absolute center of the selling that we saw across markets in July, in August. Why? Because the Bank of Japan raised rates at a quicker pace than expected, showing you that this divergence in central bank moves can have a seismic impact across FX markets. That saw the dollar yen fall from 160 down to 140 in less than a month. It also saw US share markets fall by the biggest one-day fall since Black Monday in 1987. So we expect to see further volatility in this market. You can see there's a wide range forecast, but the trigger for any moves in dollar yen will remain the divergence in central bank policies between the Fed and the Bank of Japan. But overall, you can see that we think that while there's a wide range between in the near term, 136 to 160. The overall view is for the market to trade lower from around 148 down to around 142 by the end of 2025. Dollar CNY is a market that had seen continued Chinese yuan weakness as the Chinese economic story continued to disappoint. That said, the ability for the Chinese yuan to fall further was really capped in the dollar CNY by the People's Bank of China reluctant to let this pair move above 730. So that kept a cap on prices, provided support for the Chinese yuan, but markets have really showed time and time again they do expect to see the Chinese yuan weaken further. So as we go into 2025, for the moment, moves up towards 720, towards 730, are an opportunity for Chinese yuan buyers. But there is the potential, if we see further concerns around trade or even a devaluation, or at least allowing the dollar CNY to move above 730, there's an opportunity for potential sharp Chinese yuan losses in 2025. That will be a story about the US-China trade dynamic and the story about policy from the People's Bank of China. Finishing off with the dollar Sing, the Sing dollar, despite worries about trade, saw some real strength in 2024, actually moving to the highest level in 10 years versus the US dollar. So dollar Sing trading below 130, as we said, for the first time since 2014. Why? Because inflation has remained relatively stubborn in Singapore, and the Monetary Authority of Singapore hasn't allowed any easing, with it still remaining concerned about inflation. Yes, inflation has softened, but still tracks to the long-term average, and the MAS might remain, might stay put for the foreseeable future. So that drove that Sing dollar strength. That said, dollar Sing spiked higher after that US election, in line with most moves that we saw across Asia. Overall, as you can see, we do see the dollar Sing around 133 for the balance of 2025, and potentially can move even lower if the MAS does continue to hold policy. But for now, trade is going to remain the key story, and that might mean the dollar Sing remains around that 133 level. So that's the focus for us as we look into 2025. Global growth expected to remain resilient thanks to low unemployment and rate cuts from central banks. That said, trade is the big risk. Trade is going to remain more difficult and unpredictable, and that's going to have a material impact in FX markets. What do we want our customers to consider as we go into 2025? Well, first of all, think about what unpredictable and uncertain FX moves can do to your business. What if we see material 5%, 10% shifts in your key exchange rates? We've already seen moves like that just after that US election. We expect to see more moves, more volatility in 2025. Geopolitics will be a key factor behind this. And it won't just be the moves in FX markets that are important. Think about supply chain risks, thinking about diversification. We can help with your ability to trade into different countries and reach out to your representative for more information. And again, also around other factors away from those FX market stories, but sanctions. We saw a huge pickup in the amount of sanctions, the difficulty in navigating those in 2022 and 2023. We can help your business with efficiency and security by our expertise in this area. So I'd like to thank you all for coming to the presentation. Appreciate you taking the time. Of course, if you want more information, you can download the report either on the web page you're currently on, or by going to convera.com. I'd like to thank you again for watching the presentation, and all the very best luck as we go into 2025. Thank you.